Welcome to Market Call. I'm Lindsay Biscaya. Michael Sprung is on the show today. He is president of Sprung Investment Management, and he will be taking your questions on Canadian large cap stocks. Here's how you can reach us. You can call us toll free, 1-855-326-6266. You can also email us at marketcall@bnnbloomberg.ca. Good to have you. Thanks for coming in.
Well, it's good to be back. Thank you.
We've been seeing markets surging recently. Yes. They just keep going up. You say, though, these prices reflect more of like a gambling mindset than they do an investment mindset. Can you elaborate on what you're seeing right now?
I mean, what we're seeing is very reminiscent of what we saw in the late 90s and, well, in a few other periods since I've been doing this. And usually it doesn't end too well. But, you know, one thing we look at is the cyclically adjusted PE ratios on a 10-year sort of basis. And right now, they are quite high. And if anything, I think they're reflecting the fact that, you know, on a relative basis, Canada looks pretty well priced relative to the US. So perhaps there's some safety in that. But I really think that what's going to happen is it's going to drive people more towards value stocks, which is what we do. And it's been a long time waiting for that. But, you know, when markets get valued like this, those that have been running up and are at the high multiples, they have the farthest to fall. And I think people want to be a little bit defensive right now. So they want to position themselves so that when the market comes down, they aren't going to be hurt too badly. And that's sort of where our position is at the moment.
You talk about the Canadian landscape, though, right? When we look at Canada right now, obviously there's a lot going on with the federal government trying to diversify trade, bring in some different trading partners. We're also waiting for that budget to be announced, which could maybe have quite a large deficit.
Yes.
Are these kinds of factors, are you looking at these kind of maybe affecting the market going forward? Well,
they certainly could. I mean, you're talking about a lot of political factors that, you know, as a value investor, we're more concerned is what is the price we're paying for what we expect to get in an investment. And so, you know, we look for companies that maybe don't have a great variance in earnings, pay steady dividends, have good balance sheets, that kind of thing. But certainly, you know, I remember in the 1980s, you know, Canada talked about diversifying its trade then, and they've been talking about it ever since, and yet still, you know, we've got a big, huge market that's attached to our country, and it's very expensive to ship goods overseas and things like that on a relative basis. So, you know, the United States market certainly has an advantage, and I think that what we're seeing in the negotiations right now with the tariffs really isn't going to come to any sort of fruition until we start dealing with the Canada, US, Mexico agreement next year. And I think then maybe we'll see a bit of light under the tunnel. I don't think the US wants to tariff themselves into inflation either in the long run, but I think they want a different kind of deal.
Okay. All right. So we'll have to wait and see what happens there. We are going to take a quick break now. We'll be back with Michael Sprung of Sprung Investment Management, taking your questions on Canadian large cap stocks. Stay with us. We'll be right back. Welcome back. We're going to start with an email question. This one coming in from Porter. It reads, could I please have your opinion of Atkins Realis? What do you think about this company and how the stock's performing?
Well, I think it's done extremely well. You know, it's really come back since its SNC days, and it's it's a lot different today.
Formerly SNC Lavalin, yeah.
Yes. But, you know, barring that, you know, the recent talk of all the movements into nuclear opened real big opportunities for Atkins Realis. And as a matter of fact, they've been talking about moving their capital allocation maybe a little bit away from buybacks into more M&A. And I think that's usually a sign that they see opportunity for investment going forward. So overall, despite the fact that they've had a really good run, I mean, they are now you know, the exclusive license for CANDU reactors. There's talk of building some more reactors, and there's talk of small nuclear reactors and things like that. So they will certainly get their piece of that business. But I think, the price right now, given the earnings potential going forward at this moment, it looks all right. It looks all right, but it has come a long way.
It really has. Okay, we're going to go to the phone lines now. Nizer calling in from Scarborough. Hi there, what's your question?
Oh, hi, Lindsay. Hi, Michael. Good to see you again, Michael.
Thank you.
May I have your thoughts on Chemtrade Logistics, please? The stock price has surged after the last quarterly result, but has stalled lately at around $13. What are its prospects going forward? It pays a handsome dividend.
Yes.
I recall you hold Chemtrade Logistics. Thanks for taking my call.
Okay, thank you. I mean, it has stalled a little bit, but over the last year, it looks like it's done quite well.
Yes, it has. And actually, it was a top pick, I think, last November for me. So I'm glad that it's done well, but I think it will continue to do well. It's, in terms of multiples, I think it's selling right now at around 12 times PE, but it's just selling a little bit over book value. And as the caller noted, they do pay a generous dividend. The one thing they have been doing that actually today there's a lot of news about Chemtrade because they are redeeming a lot of their convertible debentures that are out there, and they're going to replace that with presumably less expensive debt. Although it might cause some conversion into stock because a lot of these convertibles, I think, are in the money at the moment. So there could be a little bit of dilution right here, but we're continuing to hold it, and I would recommend continuing to hold it.
Okay. Move on now to Brian, who's calling in from Ottawa. Hi, Brian. What's your question?
Hello. My question today is about Constellation Software. Yesterday, something happened that I'm not too much aware of the details about, something about an investor day or conference call where some major player expressed some concern about the effects of AI, something like that. And the stock yesterday and today combined has dropped about $300. So, and it's threatening its 52-week low. So I'm wondering if you have any more information about that and what actually happened. And does this give you reason for concern about the company, or do you view this as a buying opportunity? Thank you.
Okay, thank you. Yeah, apparently Constellation Software says it's proving difficult to determine whether artificial intelligence is causing a renaissance or a recession in programming. So do you think that affects things? Like, what do you think about Constellation Software?
Well, I think the CEO called that conference yesterday to try to set investors' concerns a little bit more at ease. But, we're talking about one of the superstars of the Canadian market here. And traditionally, it is sold at multiples that are a little bit out of our reach as value investors. But nonetheless, Mark Leonard's done an amazing job of managing this company, acquiring new companies, folding them in, and expanding the range of business. Now, in terms of artificial intelligence, we see a lot of money going into artificial intelligence. We don't see a lot of revenues coming out of it yet. But that's
takes time, right?
That's a different story. Well, it either takes time or there's going to have to be so many synergies built into it that all these billions and billions of dollars going into it are somehow, someday going to pay off. But like all of these sort of nascent industries, there's going to be some winners and there's going to be some losers along the way. And I don't think Constellation's going to be one of them. Even though their business is software, and everybody's talking about, well, artificial intelligence is going to write software. Yes, but it takes a great deal of knowledge and skill to put it all together to do the applications that you want it to do. And I think that they will continue to exploit that. We've seen it come down from around $4,500 to where it is currently. Still a little bit out of my range, but I would say for people that are growth investors, I would not count this company out.
Okay. We are going to move on now back to the phone lines. Cheryl is calling in from Toronto. Hi, Cheryl.
Hi. Thank you for taking my call. I have a quick question for Michael. What are his thoughts on Waste Connections, WCN? It seems to be going sideways lately.
Okay, thank you. I will take a look at Waste. All right, we'll take a look at Waste Connections. What do you think, or would you be concerned if it's gone down a bit if we're taking a look at the last year?
It has gone down, and that's sort of typical of the industry it's in. It does have its cycles, although over time there's more and more business for them as they expand geographically and so on. I don't really have an opinion on the valuation right now, but I think that I would certainly be looking at it for an opportunity. They are well positioned in the waste business, and I think that they are one of the leaders in the field. So I would watch them.
And by looking at it as an opportunity, do you mean you maybe buy or hold?
Well, I'd have to do some work on that.
Okay,
but,
all right.
But yeah, it certainly the chart is suggesting it's getting interesting.
Okay, we're going to take a quick break now. We will be back with Michael Sprung of Sprung Investment Management, taking more of your questions on Canadian large cap stocks right after this. Stay with us. Welcome back. We're going to start off by taking more of your questions. Andre calling in from Chilliwack, BC. Hi there. What's your question?
Yeah, good morning. Thank you for taking my call. Mr. Sprung, I enjoy your insights. Thank you for Chemtrade. I've done very well with it. Could I get your thoughts, please, on Toromont, the picks and shovels of the Canadian mining industry? Is it a buy at current levels? Thank you.
Okay, thank you. Toromont, I mean, you need the picks and shovels, right? What do you think right now?
Well, I think there's a lot of excitement built into Toromont, Finning, not so much Wajax yet at the moment, but people are talking about the big projects that are going to finally get underway, and I think that the actual time for shovels in the ground might be a little bit farther out than people are counting on. So I think a lot of what we're seeing in these stocks is anticipation. And I think right now, from a valuation perspective, I'd be looking for a little bit of a setback before I invested in any of them, except for we do have some investment in Wajax because we think it's so far undervalued. But
do you think there is a setback coming potentially for this kind of market?
Well, depends how much.
You predict the future.
I guess politicians are going to continue to talk about all the big things that are going to come that's going to save the country and create economic value added. But we're a long way, I think, from seeing any of it actually happening in terms of the really large projects.
Okay. Gordon now calling in from Victoria with a question. Hi, Gordon.
Good morning. Atco has a very small modular home division, and the chairman, Nancy Southern, was at Carney's modular home announcement in Edmonton the other day, and she got a shout out. Just as an aside, Don Farrell used to be on the board of Atco. Will Atco benefit materially from the free government tax dollars that's going in?
Well, I'm sure they're looking for a way that they can participate in that. What Atco is famous for is, of course, making the modular houses and so on that could go into development projects that people could use for a while as offices and some temporary residences and things like that. And you see their little blocks of things all over the place. We own Atco. We like it. We think that this is probably another opportunity for it. The big part of Atco is still Canadian utilities, and we like utilities at the moment, particularly with the demand for growing energy needs, which is going to cause more capital expenditures in those areas, which is going to grow their rate basis and so on. So we like Atco. I wouldn't buy it solely on the basis of modular housing, but it certainly is an opportunity that could face them.
Okay. Tom now calling in from Kingston, Ontario with a question. Hi, Tom.
Thank you for having me on, both of you. I'm actually calling about all the banks. I see Commerce as being the most Canadian bank. Correct me if I'm wrong. And again, we're on the topic of these new projects that Ottawa is pushing. Will these new projects make a material change to the banks or is it just a small matter for the banks? And which the banks would profit most from these new projects. Anyway, I'll hang up and listen. Thank you very much.
Okay, thank you. Yeah, taking a look at all of the banks,
Sure.
but I mean, is there one in particular?
Well, Commerce is one of the main ones that we own. We also own Bank of Nova Scotia and Royal Bank. And, within the realm of banks, Royal Bank is sort of the king, and they are good at everything they do, and they're big in everything they do. In terms of Canadian orientation, it depends how far you want to extend the banks, but I'd say, perhaps National is a little bit more Canadian than even CIBC to some extent. But I think there is opportunity for them in these projects. I mean, to the extent that they are all involved in capital markets. Big projects demand a lot of funding, and certainly the underwriters make a lot of money on finding financing, whether it be through equity or debt, for these projects. So I think that it's a big opportunity for all of them. In terms of relative valuation at the moment, I think that the Commerce is pretty well priced. I would recommend it here.
Okay. We're going to move on now to Stan, who's calling in from Niagara-on-the-Lake. Hi, Stan. Hello? Okay, maybe we lost Stan. Do you know he had a question on BCE? So maybe we can just ask you about BCE right now and how that stock is looking. It's gone down a bit.
Well, yes, it's gone down a bit, and we own it, and we've gone down with it.
Right.
So I'll put that up front. We own BCE and Telus. We're continuing to own both of them. I think the market's beginning to look a little bit past 2025, and what we've seen is a highly competitive market in the wireless area. Margins have been under pressure. There's been a lot of pricing competition and so on. I think people are looking for that to stabilize a little bit going forward. Perhaps it's from maybe having less immigration coming in or whatever, but I think all of the telecoms would like to see a little bit more stabilization on the wireless side. The other thing that BCE did, of course, which sort of surprised people, was buying Ziply in the United States, which is into laying down a lot of fiber optic cable. And they've got some CapEx going ahead there, but they're talking about, something like 500,000 expansions into, new potential customers and so on. And I think that BCE right now, I would not sell it down at the levels it is. It pays a pretty good dividend, 5.5% yield, I think. And, I don't think there's a lot of downside from here.
Yeah, 5.5%. Okay, that's good to know. I should also just mention as well, Bell Media, of course, is the parent company of BNN Bloomberg. So I just wanted to get that in there as well. We're going to move on now to an email question. This one coming in from Vivek. It says, I want to get your view on Goeasy after a short seller report. You think it's legit, and will the stock go back over 200 soon? Goeasy, what do you think? I mean, can you predict that the stock's maybe going to go back over 200?
Well, no, but we see these short selling reports come out from time to time. You wonder how short the people who are putting them out are at the time they put them out, which real opportunity for them. I think what they were hammering on Goeasy was they're claiming that they are taking on, lesser credits that are more risky, and we're in a market where consumers are becoming more pressured. I think Goeasy is a pretty well-managed company, and it's been around enough years that I'm fairly certain they've got enough reserves against that at the time. So I believe there could be some recovery in here for them, but it's not one that we own, and it sells at multiples that we don't find attractive from our point of view at this point in time.
Okay. All right, we're going to take another quick break. When we come back, we will be taking a look at Michael's past picks. That's next. Stay with us. Welcome back. We are going to take a look now at Michael Sprung's past picks. These are from October 4th, 2024. First one is Linamar. At the time, $64.67, now $76.96. A return of 19%, total return of 21%. Did pretty well. You still holding this one?
Yes.
Yeah.
And if anything, I'm surprised it's done as well as it has in light of the tariffs and the talk about the auto industry and how that's going to work out between Canada and the U.S. But as I was saying earlier, I think at the end of the day, both the U.S. and Canada want efficient manufacturing that keeps prices at relatively affordable levels for consumers. And so I think Linamar will definitely be one of the survivors. We continue to hold it. Right now it's still selling at under book value, and despite the fact that it's got a ROE somewhere around 8 or 9%. And, you're not holding this one for yield, but I think what you're looking for is an expansion in business. The PE is a little bit high at the moment. I think it's over 20 times trailing. But going forward, I think we could see that drop fairly significantly.
Okay, we're going to move on to your next past pick as well, Whitecap Resources. This one I recommended at $10.92. Now it's at $11.12, a return of 2% and a total return of 8%. I saw you laughing there. I mean, this did okay too, right?
It's up.
It is up.
It is up. And, after being on this show a long time, there are times when you come on when they're all up and there are times when they're all down. And, a space of how many months is in between is kind of random. But no, we still own it. We like it. I think on a PE basis, fairly reasonable at about 7.5 times. They have a good return on equity, which I think sustains their price to book, which is about 1.6 times. The thing that I think investors like is it has a really good yield on it right now, over 6.5%. So we would continue to hold it.
That's something that it sounds like you like to look at that, right? If a company does have a good yield, that's something that's important to you?
I like companies that pay dividends. We'll invest in companies that may not necessarily pay dividends, but we have to see the potential for a lot of capital appreciation in there. But I prefer to see dividends over stock buybacks, and because I like to see it return to all shareholders. And usually stock buybacks sometimes are a sign that there's not enough capex in the business to profitably put the money in there. I mean, in theory, they should be either paying the money out to the shareholders or investing it into the business to grow the business. I think that from our point of view, that's what we prefer. Okay.
Last past pick that we're going to take a look at is Alaris Equity Partners, recommended at $18.22, now $19.35, return of 6%, total return of 8%. This one has a good yield as well, 7%. You still holding this one?
It typically always has it. Well, and people who've watched this show over the years know that I've been a fan of this company for a long time. And from my point of view, if you want exposure to private equity, this is a good way to do it, because it's a way that you can have exposure to private equity, because this is a company that's in the business of investing in private companies and doing so in such a way that they earn a sufficient yield on either their preferred stock, or they now will invest some common stock in them as well. Over the years, they've done extremely well, even on the companies that haven't worked out, that have had to buy their ways back out of the agreements. They've done well on that. It's selling just under book value at the moment, so I would still strongly recommend Alaris.
Okay, we are going to take a quick break. We'll be back with Michael Sprung of Sprung Investment Management, taking your questions once again on Canadian large cap stocks right after this. Stay with us. Welcome back. We are going to go back to the phone lines now. Suzanne calling in from Quebec City. Hi, Suzanne.
Hi, good afternoon to both of you. I would like Mr. Sprung's opinion on WSP Global. I own a half position. I think I purchased it a few years back, so I'm doing really well on it. But to my amazement, I just saw that they went down. They're down quite a bit today, and I did some research when I came home about an hour ago, and I don't see any news. So perhaps you can enlighten me on this. Thank you so much. Bye-bye.
Okay, thank you. WSP, I'm just looking now to see why they went down so much. We can look at the charts at least, first of all. I mean, cause for concern when you look at how much they've gone down?
Not necessarily. I'd like to see what the news release was about, but I don't know at this point in time. But 3.6% for WSP in a day is fairly significant. But you look at WSP against its peers, whether it's Atkins Realis or Stantec or many of the other big engineering firms. And they tend to be, over the years, extremely well managed. And they've always had a premium valuation as a result of that. So, I mean, right now I'm just guessing, to tell you the truth, but maybe it's just bringing their valuation a little bit more in line with some of the others. Yeah,
we're trying to look to see why it's actually down. Not sure either, but it's down the most it has been in 7 weeks. So,
yeah, well, 7 weeks.
Yeah. Okay, we'll move on now to Alan, who's calling in from Annapolis Royal in Nova Scotia. Hi, Alan.
Hi, thank you for taking my call. Michael, I'd like your opinion on TELUS, and is the 7.6% dividend sustainable? I'll hang up and listen to your answer.
Okay, thank you. Tell us, what do you think?
Well, yes, we own it. I own it. I certainly hope it's sustainable. But like we were saying before about Bell, what we're hoping for in this industry is a little bit more stability in the pricing market, and not so sort of the cutthroat competitive market that we've seen. And TELUS has always been, an extremely well-managed company. We own it and we own Bell. Some other people, I mean, Rogers, relatively speaking, has done really well over the last year in terms of their stock. And they're sort of into more businesses outside of the telecom area, I guess. BCE is sort of retracted from some of their businesses. And TELUS has got, some subsidiaries that they've either bought back in or some of them have done well. But I think it's still fairly valued, and I like the dividend, and I'm pretty sure that it's sustainable from here.
Because as Alan mentioned, like that dividend, 7.6%, that's pretty high. Is there a point where you start to think a dividend might be too high? I guess it depends on the company.
Depends on the company. Certainly when dividends get over 10%, you become fairly concerned, and you start to dig in, find out why. But even in today's market, you look at the average yield on companies, and anything over 6% is beginning to look pricier and pricier as you go up the ladder.
Okay. We're going to move to an email now. This one coming in from Jim in Montreal. It reads, Mr. Sprung, thoughts on Metro as a grocer/pharmacy chain? Appreciate it. P.S. Favorite guest, all-time old school value investing. There you go. Another fan. Okay, Metro, what do you think about this company?
It's not one that we own. Our exposure to the grocery business, has been through Northwest Company, which is a little bit of a oddity in the market positioning it's in, but it's been primarily through Weston and Loblaws, which has done very well. The one thing I have noticed, though, is over the last 6 months, the consumer staples that really seem to be the place to go for safety, in the year prior to that, they have not kept up with the market to a great extent. And, a lot of this might be concerns over inflation and what is their ability to pass prices through, because the one thing politicians scream about is the price of groceries. And I think that they try their best to be competitive, but the margins in grocery is so thin that there's not a lot of room. So I think that we're just seeing a bit of a price adjustment here. I would continue to look at Metro. I think they're well positioned in the discount grocers too through what is it, Basics?
Group Basics?
Group Basics. I can't remember. Anyway, they've got their Basics. Sobeys has got their discount brokers. Loblaws has got their no frills, and they're seeing a lot more business going down into those levels, which are maybe even thinner margins to some extent. So that could be part of the reason too.
Okay, we'll move on to the phone lines now. Colin is calling in from Kingston, Ontario, with a question. Hi, Colin.
Hello, my question's on the TD Bank. It's had a phenomenal run for the last 6 months. I've noticed its trading volumes have really tapered off. It's not even halfway through average, and I'm concerned maybe it's going to start drifting lower. I just want your take on that. Thank you.
Okay, thank you. TD Bank, would that be a concern for you? Or you?
We don't look a lot at the technical aspects of stock trading and the, whether volumes are going up or down in a particular stock. The TD had a lot to catch up on after the anti-money laundering incident, and they have had a significant change in executive management. And I think as that occurred, there was a lot of hope for recovery in the bank, and the price went up considerably, probably faster than any of the other banks were going up at the time. And I think now it's more just a realignment of valuation. The one thing about TD, I think, that could be causing some concern is the fact that since the anti-money laundering, their expansion in the U.S. is somewhat limited for the time being. So I would take that into consideration. Within the banking group, it's not one that we have any exposure to.
And it would not be one. I understand you don't have it, but
we don't have.
Yeah.
Well, we try not to buy the whole group.
Fair enough.
So we try to pick and choose, and TD just happens to be right now one that we haven't chosen. But.
Okay. All right, we're going to take another quick break. We'll be back with Michael Sprung at Sprung Investment Management, taking more of your questions on Canadian large cap stocks. And we'll be back right after this. Stay with us. Welcome back. We're going to take more questions now. We've got a caller, Jim, who's calling in from Peace River, Alberta, with a question for Michael Sprung. Hi, Jim. What's your question?
Hi. Thank you for taking my call. It's on Canadian Natural. I like that they're paying down debt, but do you see them growing through acquiring smaller Canadian companies, oil companies, or just staying the course? Thank you very much.
Okay, thank you. Canadian Natural Resources. What do you think about them acquiring smaller Canadian companies?
I think that's entirely possible. I mean, they're not a company that over the years has necessarily stood still in the M&A field, and they've done extremely well. And it is probably one of our two primary holdings in the energy area. So we are still big believers in Canadian Natural Resources. And I think that right now, quite frankly, we're fairly bullish on energy, and particularly oil and gas going forward. So I think that...
because of some of the projects that are happening in Canada along the West Coast, or why is that?
Well, I think it's also because, we've seen lately BP and Shell, for instance, saying that they're going to cut capital expenditures in clean energy and move more back into increasing oil and gas production and so on and so forth. I think, one effect that the U.S. has had in the energy market is to bring focus back into the oil and gas sector, and I think there is growth potential in that.
Okay. Jim now calling in from Parksdale, BC, with a question. Hi, Jim.
How are you?
I'm good. How are you?
I'm good, thanks. Thanks for taking my call. I'm wondering about the Royal Bank. I've owned it for about 17, 18 years now, I guess. I bought it for just under $60 a share. My question is, do you see a split coming in there? A 2-for-1 or 3-for-1?
Okay. All right, thank you. Lots of bank questions today. We'll get right to this question. Do you see a split?
It's always possible. I think the banks over the years have been somewhat reluctant to split their stock, but every once in a while you see that occur. And one of the reasons is that, well, people can't buy an even lot if the price gets too high. Nowadays, that doesn't make such a big difference in the market. I mean, you can buy odd lots quite easily. Even a lot of companies are allowing you to buy fractional shares now. So, the only reason I could see that happen is they just want to see liquidity expand to some extent. It happens to be one of our primary holdings in the bank area, as I said earlier. We like the Royal Bank. It is sort of the captain of the bank industry in Canada, and I think it will continue to be so.
Okay, we're going to move on to our next caller now. JP calling in from Edmonton. Hi there. What's your question?
Hi, welcome to the show, Lindsay.
Thank
I think
you.
you're new since I started watching, and since you were saying you're not getting enough bank questions today, I was going to ask about EQ Bank. So I know they've had some unfortunate turnover at the C level, but what are your thoughts on growth forecasted going forward? I'll hang up and listen to your call. Thanks.
Didn't say we didn't like bank questions. Okay, EQ Bank, what do you think about where they're moving towards?
I think the EQ Bank is quite an interesting bank, and in terms of they're the most exposed bank to mortgages in the mortgage market. And we've seen so much of that disappear in the last few years. We used to have the opportunity to invest in home capital, and then they were taken up by First National, which has now been taken up by someone else. And so, they are still in that business primarily. So I think that it's interesting from that perspective. If anything, I'd say the recent pullback in the bank is maybe more worrying about the macroeconomic ability of mortgage holders to renew their mortgage. We've got a large portion of mortgages renewing through the rest of this year and into next, and they will be renewing at much higher rates, and so that could put some pressure on the credit quality of something like an EQ Bank. But, it was a real tragedy that their CEO and founder passed away so unexpectedly. And I think they've taken, I think they've brought in pretty good people to sit in and replace that. And so I'm hoping for the best for the EQ Bank. We don't own it right now. Valuation-wise, it just looked a bit expensive to us, but it has been drifting down lately.
Got it. All right. Mike calling in now from Sudbury, Ontario with a question. Hi, Mike.
Hi, thanks for taking my call. I'm calling about TC Energy. I've done quite well with this. I bought it at 44. I was considering trimming a bit lately, but they came out with this announcement today that I'm thinking is positive, making more investment in the States. So I'm wondering if you see more upside with this. Thank you.
Okay, thank you. Yeah, that announcement saying they're going to be investing more in the States because they see a better return. It just looks more attractive to them, they said. What do you think?
Well, I think that's true. And up front, TC Energy is one of our primary holdings in that area, in that sector, along with Enbridge. And I think they do have great opportunity going forward. And I think right now, just looking at the political machinations between the U.S. and Canada, they probably see more opportunity to invest and expand in the U.S. right now than they do in Canada. So I think that they do have a future of growth going forward. I mean, the way these are highly levered companies, and the only way they keep growing is by expanding their footprint and getting more of those revenues flowing in through the pipelines and so on. And I think that TC Energy is well positioned to benefit going forward.
Okay, that's it for calls today, but don't go away because Michael will share his top picks coming up right after the break. Stay with us. Join us tomorrow on Market Call. Dan Rohinton will be on the show. He is a portfolio manager at IA Global Asset Management and will be taking your questions on Canadian and global large caps. And if you miss Market Call, you can always check out our daily podcast. You can find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. And time now for top picks with Michael Sprung. The first top pick is Canadian National Railway. And you say the railways are a mirror on the state of the economy. So obviously you're liking this one. Why is that?
Yeah. Well, you know, they are the plumbing of the economy. And if anything, I think the enthusiasm for the railroad stocks has been constrained a little bit by the tariff and trade tensions that have taken place, as well as concerns about the possibility of a slowing economy and lower commodity shipments. You know, this hasn't been a great year for agricultural shipments, and with the tensions with China on canola, that's also going to have an effect with the railroads. So it's a period like these that the valuations begin to look quite attractive, I think. And as I was saying earlier, I believe that next year, when we get into the Canadian, U.S., Mexico trade agreements, out of that is going to come a better North American economic footprint for the railroads going forward. So if anything, I'd say now is time to take advantage of that. You know, from a pricing perspective, right now CN might have a slightly lower PE than CP, but you know, it's compensated for to some extent by a higher price to book. And but on the other hand, over the years, ROE has sort of, I wouldn't say consistently, but it's sort of tended to trend higher than that of CP. So I think that it would be my choice in the railroads at the moment, but that can change.
I have noticed on the show we do get a lot of questions on whether CN or CP is a better buy, right? So obviously you're saying CN.
Yeah, I'll say CN. I know a lot of my competitors are probably saying CP, but.
Hey, it's a good Canadian company. Okay, your next pick is Aecon Group. What do you like about Aecon Group?
Well, I think that, you know, in their last quarter, they ended the quarter with a record backlog, $10.7 billion. I think that by the end of this year, the legacy projects which have held them back, that were not cost-plus projects, they will disappear. And going forward, I think that if there is a lot of expansion projects, Aecon will definitely be participating in them. I mean, right now there are sort of 5 possible projects that I think they might be adding into their backlog with some participation in. You know, they don't tend to be the only company involved in a lot of these, but there's the Go Transit one that's coming up. There's a Contrecoeur terminal expansion starting. There's expansion in the U.S. Virgin Island airports, which they have a concession as well as a construction probably window on. And in Winnipeg, there's going to be a big sewage project. So I think there's a lot of projects on the horizon that we could see this company's profitability beginning to rise over the next few years. And I think it's fairly attractively priced right now.
So looking good in the future, and also a yield of 3.3%, which doesn't hurt.
Doesn't hurt. Could be better, but
it could be better, but yeah, it could be worse as well. All right, let's move on to your last pick. Top pick, Hammond Power Solutions. You talk about the demand for electricity rapidly increasing. Is that part of the reason you're looking at this one?
Well, definitely. I mean,
the main reason?
We've got billions of dollars going into artificial intelligence and server farms and demands for electricity going forward, and the electrification of our economy and so on and so forth. And you know, Hammond Power is definitely one of the companies that's going to benefit the most, because they make transformers, and you don't move electricity from point A to point B without transformers. So I think they are extremely well positioned. You know, our initial purchases of this were quite a bit cheaper. We did unload some of our position when it got up to around, I think, of close to $150. Now it's settled back to the point where I think that I could recommend it again as being a long-term good buy for capital appreciation. You're certainly not buying this for the dividend. You're buying it for the capital appreciation potential going forward. But I think they will continue to be a key player in providing transformers to the electrical market.
So you said you sold off some of it a little while ago. Was that because you weren't feeling as confident in the future of the company, or just
no? It ran up so fast, and it was $150. And the main reason was because it was a much larger holding at that point than we wanted to have in the portfolios, so we scaled it back.
And now you're saying again, you think it's a good time to buy in?
Yes.
Okay. All right. Thank you for joining us today. Appreciate it. That was Michael Sprung, president of Sprung Investment Management, joining us. And thanks again for watching Market Call. We will see you next time. Thanks.